Good evening, class 11th. Welcome back. New session. Now, in my last video, we discussed about the basic assumptions. We learned about three assumptions, which is going concern, consistency, and accrual. I hope you all understand that because this is an important part. Now, next part of accounting principles. Now, in this particular topic, we are learning about the accounting principles. What are the accounting conventions? So basically, there are different types of accounting principles are there. In our 11 principles are there. We are going to discuss one by one. Now before that, I hope you understand the basic assumption, the basic accounting concepts, which are going concern, business always remain for continue for the longer period. No business can open for a 3 to 4 months or only for a year. The businessman assumes that the business can be continued for a longer duration or longer period. Then principle of we learn about the second assumption is called consistency and then accrual. Now here we are talking about the accounting principles. Now what are different accounting principles here? We are discussing about the accounting principles. Or in simple term we call it the basic accounting principles, accounting conventions. Now what are these? These are certain guidelines, there are certain rules or there are certain principle in which all the business works, and that's a very important part because if we do the practical part of accountancy, all the practical part of accountancy is depend upon how we understand the different principles, because all the accounting approach, whether you prepare journal entries, whether you make accounting equations, whether you make ledgers, whether you make final accounts, and later period you learn about profit and loss appropriation account, balance sheets, cash flow statements, PL appropriation account ratios, they all are based on this accounting principles. So we are learning about different accounting principles. The first one is, the important part is called business entity principle, or we call it accounting entity principle. Now what is this? First I will explain, then you note down the thing. The first one is accounting entity principles. This principle states that according to this principle, business is treated as a separate entity, means which is separate and distinct from its owner. It is further assumed that business has its own identity or distinct from the owners. Now what it means? What are these parts? Understand them. Suppose we know that you heard the name Reliance Industries Limited. You heard the name Reliance Industries Limited. They are dealing in many products. Now, who's the owner of Reliance Industries Limited? It's Mukesh Ambani. I hope it's clear. Now, Mukesh Ambani is different person and Reliance Industries Limited is a different person. They two are different. One is an artificial person. Reliance Industries Limited is a group of person we treat as artificial person. But Mukesh Ambani is a natural one. But the main understandable part term in that category, understanding term, important बात यह है, Mukesh Ambani is a different person and Reliance Industries Limited is an artificial person, but the Reliance Industries Limited has its separate identity. Similarly, Tata, Ratan Tata is the chairman, was chairman of Tata Group, but Ratan Tata and Tata Group are different person, are different. Ratan Tata is a natural person and Tata Group is an artificial one. But they do have the different identity. Same about we say the Aditya Birla, or we say Kumar Mangalam Birla. He is the chairman of Aditya Birla Group. The Kumar Mangalam Birla is a different person and the Aditya Birla Group is an artificial person. Similarly, suppose Mukesh is a person, he started a business called Mukesh Enterprises. Mukesh Enterprises. Now understand term, this Mukesh Enterprise is a separate thing and Mukesh is a separate person. Suppose Mukesh Enterprise is dealing in refrigerators. They are dealing in refrigerators. Mukesh Enterprises is dealing in refrigerators. Now if you purchase refrigerator from Mukesh company, Mukesh Enterprise, and for God's sake रेफ्रिजरेटर में कुछ खराबी आ गई, you didn't say मुकेश भाई आपके रेफ्रिजरेटर में खराबी आई. No, you have to compare to Mukesh Enterprise because understand that because You purchase from Mukesh Enterprise, not from Mukesh. Of course, Mukesh is the owner of Mukesh Enterprise. Understand them? Second part, when you pay the money, when you purchase refrigerator, you not pay the money to Mukesh, you pay to the company. You pay to the firm. So this is an important part. So what is the principle says that? This principle assumes that, or this principle says that business is treated as a different entity which is separate and distinct from its owner. Okay, note down please. This principle states that okay, this principle states that business is treated as an entity. Business is treated as हम बिजनेस को एक एंटिटी मानेंगे which is separate and distinct from its owner, which is separate and distinct from its owner, from its owners. Obviously, we separate and distinct from its owners. It is further assumed that business has its own identity. Business has its own identity which is distinct from the owners. I hope it's clear. Okay, now simply understand them. Owner and his business, whatever doing in business, is different person. Owner and business, they are two different persons. Okay, I hope it's clear. The first accounting principle states that business is treated as a different entity which is separate and distinct from its owner. Means owner and business are two different persons. The businessman is a natural person, but the businessman is a natural person, but the business is considered as an artificial person. Okay. Now next principle. The next principle states that we are talking about the next principle. Note down. I hope you note down the first one. Second principle states that it's called money measurement principle. Money measurement principle. Second principle is money measurement principle. Now what is this? Money measurement. You heard the name money measurement. According to this principle, a transaction will be recorded in the accounting book only if they are measured in terms of money or some quantity terms are there. So money measurement principle is that whenever you purchase something or whenever you are dealing in any economic activity, that economic activity should be recorded in the books when it has some monetary value. When it has some monetary value. So please understand this one. Money measurement principle. This principle states that a transaction will be recorded in the accounting books when you pay money if they are measured in terms of money. Obviously, means suppose you purchase a land for business. You don't say I purchase 3-acre land. It's a wrong thing. You have to say we purchase a 3-acre land for the business purpose costing 1 crore rupees or 50 lakh rupees, whatever amount you pay for purchasing the land. So this principle, money measurement, says that every transaction, those transactions can be recorded in the books of account which can have monetary value, which have some monetary value. Okay, so we say money measurement principle. Okay, I hope it's clear. Money measurement. Now note down. According to this principle, a transaction will be recorded. A transaction will be recorded in the books. A transaction will be recorded in the books. Recorded in the accounting books. In the books means accounting books. Only if they are measured. If they are measured in monetary terms. Okay, I was clear. You have to mean, suppose you purchase anything. Say I have a building which I'm using in business. So what is the cost of building? What is the cost? At what price you purchase a building? It should be recorded in the books. So it had some monetary value. Now, example, understand them very carefully now. Now, you know that there are certain things which are, what is the main disadvantage of money measurement? The main thing, you know that adverse impact on sales due to lack of coordination between sales team and production team. I'm giving you a disadvantage of money measurement where the money measurement principles lacks, or where we say it's a failure of money measurement. Because everything should be recorded in terms of money, but there are certain business terms which are having an effect on our business, or whether it's a positive effect or negative effect, but they have the effect. For example, adverse impact on sales due to lack of coordination between sales team and the production team. The lack of coordination is here between sales team and the production team. This cannot be recorded in the books of account. Now, of course, if there lack of coordination between sales team and the production team is here, of course, this provides a negative effect on the company. However, you understand that this provides a negative effect on the company, but this thing cannot be recorded. However, if you say loss of goods by fire, it can be recorded because you say goods worth rupees 50,000 are lost by fire. It can be recorded in the books. इसको बुक में रिकॉर्ड किया जाता है. बट एक अच्छा एम्प्लॉय कितना अच्छा बिजनेस कर रहा है और एक अच्छा एम्प्लॉय कितना अच्छा पॉजिटिव इंपैक्ट डाल रहा है, उसकी वजह से सेल बढ़ रही है. सपोज यू हैव वेरी गुड मार्केटिंग पर्सन, उसकी वजह से सेल बढ़ रही है. इट कैन नॉट बी रिकॉर्डेड इन द बुक्स. तो वी ठीक है डजंट मेजर द क्वालिटेटिव एस्पेक्ट्स. Everything we measure in terms of monetary terms. So these are disadvantage of money measurement. I hope it's clear. We record loss of goods by fire, but a positive person, a person who has a positive impact, a person who's playing a very positive impact on the company's side, उसकी वजह से sales increase कर रही है. This qualitative aspect cannot be measured in terms of money. So this part is clear. What is money measurement concept? According to this principle, a transaction will be recorded in the accounting books only if they are measured in monetary terms. Okay, next part is after money measurement. Okay, third part is accounting period principle. Okay, this one is accounting period. You know that we already discussed in accrual basis also in assumption going concern. The business is generally done for the indefinite period, for the longer period. Nobody want to do the business for 1 year, 2 year, or 2.5 years, 3 years. The business may have a plan to the business for an indefinite period, for the longer period. So what is this principle? Accounting period principle. Accounting period principle. It says that you have to record, as per accounting period concept, you say the whole life of business enterprise is divided into smaller periods. Is known as accounting period. Now why? These business enterprise is divided into smaller periods. The accounting period is usually a period of 1 year. That 1 year will be a financial year or calendar year or any year of period. But however, for taxpayer, the accounting period should be a financial year. It means that starts from 1st April to 31st March. But what is this accounting period principle? Now suppose a business is running for 30 years and after 30 years it shut down his business, or means उसने business बंद किया or maybe sold to some other person, but he shut down the business after 30 years. Now after 30 years he want to record what is how much I earn, or how much my profit is there, how much my goodwill is here, how much whether I earn a sufficient amount of profit or not. No, this very after 30 years it's very difficult to record. Suppose this person started business in 1980, okay, and 2020 he shut down, and after 2020, in 2020 you want to notice that I started business 1980, whether I earn sufficient amount of profit or not, how much I earn in 1980, how much I earn in 1984, 1985, it's very difficult to find after the end of the period. That's why accounting period says that you have to record, you have to maintain the books for a certain period. It means this period, you divide, say after 1 year, in 81 you maintain books, and 82 you maintain separate books, 83 is maintained separate, same 84, that's goes on for different period. That this different period, it's easier for the business to record the events or record the transaction which taken place in the businesses. Now for this thing, the business should record, the business can identify in first year how much you earn, in second year how much your profit will increase, in third year how much we have to bear the losses, in fourth year what's your plan for expansion, how much we put for the expansion of the business, how much we put for the advertisements, how much we put for the innovation. Now these are the things, or how much we created general reserve. Now it's easy to identify when we maintain the accounts for a particular period, and this period is called the shorter periods for say for 1 year. So every time accounting period says that you need to maintain the accounts for 12 months. Need to maintain the account for, it's not compulsory to maintain the account for 1st September 31st March, but generally the business do so. But you say that as per this accounting period concept, the whole life of business enterprise is divided into smaller periods. So this 1 year period is called smaller periods. Is it clear now? And this smaller period known as accounting periods. So note down please. As per accounting period concept, the whole life of business enterprise is divided into smaller periods. This smaller period is known as accounting period. Is it clear? This smaller period known as accounting period. Now this smaller period. Now it's easy to identify because you are suppose you started business 1st January, at 31st March you close down. Oh sorry, you change your books. So it's easy to identify in 12 months how much the money you put in business and how much you return for that. Kitna aapko return mila. This is easy to identify. Now that's why they say that you have to maintain the books of account for 12 months for a smaller periods. Okay, is that clear now? Now these smaller periods is called accounting period. The book should be closed after 1 year. The next book need to maintain. From the books, whatever the books we close, from that when we study that book, we find out, because the first principle when I teach you the accounting advantages also, I say what accounting does. From the whatever you record, whatever the economic trends you record, from this book we summarize, then we analyze, and then we interpret. Okay, whatever we earn, how much we earn. Is it clear now? So this thing is divided into smaller period so that we can understand the books of account. The accounting period is usually a period of 1 year. Usually a period of 1 year. That 1 year will be a financial year or a calendar year. It's not compulsory, means you record, maintain the accounts from 1st April only, but generally the business do so. Okay, this 1 year will be a financial year or a calendar year. Any year of 12 months, generally for 12 months. But however, for tax payer, for tax purposes, the accounting period it should be a financial year. Will start from 1st April and ends on 31st March next year. Is it clear now? I hope you understand. So as per this accounting period concept, the whole life business enterprise is divided into smaller periods, which is considered as accounting period. Accounting period is usually a period of 1 year. That 1 year will be a financial year or a calendar year or any year. Is it clear? Any year for 12 months. However, for tax purposes, the accounting period should be a financial year. We'll start from 1st April to 31st of March. I hope it's clear. And if you want, should I write? Or so you understand that? If you cannot understand this, I provide you notes also. But you understand in terms what is accounting period. Okay. Next principle is full disclosure. Full disclosure concept. Now, what is this? Full disclosure concept. Right here. Full disclosure. Okay. The full disclosure concept. Now, understand this sum. And I give you notes also. This principle directs that there should be a complete, understandable, fair and sufficient information in the financial statement, and all the significant information should be fully disclosed in a financial statement. Now whatever information you record in the books of account, this principle says that whatever information you record in a fully all the transition, all the economic events which affects business should record in the books of account. All the economic events, whatever is here, whatever which makes a positive impact or negative impact should be recorded in the books of account. Means accounting, when you prepare the financial accounts, when you prepare the accounting, when you prepare different accounts, it contains all the information which are associated with the business in monetary terms. This is important part. In monetary terms. So this principle is a full disclosure. You have to show all the information which are related to a business. You cannot hide any information for the business. Cannot be hide any information for the business. Because suppose there are three partners are there, A, B, C, and C withdraw the money from the C withdraw business money and move away. Now this information, if you cannot show in the books, it shows a wrong information. It shows the wrong information. The business says that you need to record all the information which are related to the business. So this principle is called full disclosure concept. Now write down. This principle states that there should be a complete understandable now what is understandable information? There should be a complete understandable, fair and sufficient information. Complete understandable, what is information which is related to business? Complete understandable, fair and sufficient information. Fair means which is correct, and sufficient information now which information? The economic events in the financial statement. In the financial statement. In the financial statement, all the sufficient information should be fully disclosed. All that means all the financial statement. What are the financial statements here? It should be fully disclosed. Means you cannot hide any information. If you hide any information, it makes a wrong impact in the books. Means you get the business. If you pose a wrong picture in that, then it shows maybe a wrong profit or wrong losses. Okay, examples are there. You know that contingent liability. Okay, what is contingent liability? The liability which we have to pay, which is not sure whether we have to pay or not. I'll give you in previous when we running out the accounting concepts in which we discussed some contingent liability. Now contingent liability are those liability which is not sure whether we have to pay or not. But the firm mentally prepare was the same. Now what is contingent liability? Example of guarantee, warranty. Firm provide a warranty. Suppose you purchase a port from us, or maybe it's a refrigerator, it's a AC. If something wrong happen, if any of the things which is mentioned in the warranty, उसमें कुछ भी खराबी आती है, तो we can replace them, or we can change them, or we can change the particular part. This is called warranty, but company need to spend money on that. So this is called contingent liability. This part is called contingent, which is not sure whether we have to pay or not. So this contingent liability always shown in the balance sheet, in the footnote of balance sheet, as an anticipated loss. वो loss जो अभी हुआ नहीं लेकिन हो सकता है. This term is called anticipated loss. So this in balance sheet they disclose this information. They're not paying yet. They have to pay when this liability arises. But firm need to show in their books. So contingent liability shown in the footnote in the balance sheet. We will study about the balance sheet also. But this contingent liability is called firm is anticipated the loss. If the loss arises, which arises in futures. Loss which arises in future. So these are terms. So this principle states that you have to disclose each and every information in order to find out the correct information, the correct pictures of business. That's why you understand them. What is contingent liability? Guarantee, warranty is a type example of court cases. Suppose any employee or any of your worker or any other customer who's not satisfied with the product, he put a court case in that. And suppose if you lose the court case, you have to pay money. You understand now? This term is called contingent liability. The firm always make a balance of the same. Means these are contingent liability. It can be arise in future. I hope it's clear. Next, after contingent liability, after full disclosure concept, we move further. I hope. Which one? Fifth one. Principle of materiality. Principle of materiality. Now, what is this thing? Principle of materiality. This is a fifth principle. Okay. Principle of materiality. They say that items having significant effect should be disclosed. It may happen that one fact is material for someone but not for others is an important one, because material information means, first note down, items having significant effect, items having significant effect, item which having significant effect, okay, significant effect should be disclosed, items having significant effect should be disclosed. It may happen that one fact is material for someone but not for others. Now, example. Suppose, I'll give you your example only. Suppose, Sumit is a person, okay, and Sumit is a very rich person. As is a very rich. He's getting a pocket money rupees 10,000. I'm talking a huge amount, 10,000 every month. I said 10,000 rupees की pocket money मिलती है. Okay? सुमित के 100 rupees खो गए. सुमित के 100 rupees खो गए. I understand that. Sumit lost his 100 rupees. Now, यहाँ पर एक beggar भी है. This beggar, he loses 100 rupees. He also loses 100 rupees. Now, who matter most? It's matter most for whom? Sumit say 100 rupees खो गया. No one, no worries. There's no worry about this thing. It doesn't make any impact on me. But for beggar, this 100 rupees matter. For beggar, this 100 rupees matter. So what I'm saying, items having significant effect should be disclosed. It may happen that one fact is material for someone. Means this 100 rupees matter for beggar, but not for Sumit. To identify in terms of business. Means that for some business, there's some material information are there, which is matter for one, it doesn't matter for the big businesses, but matter for the small businesses. Now, example. Suppose you have a business, a garment shop, a garment showroom. You offer tea or coffee or cold drinks to your employee or to your customer, and say daily you are spending around about 300-400 rupees, and you are earning around about 1 lakh rupees in a day, and you are spending around 1,000 rupees in a cold drink, tea, coffee, snacks, whatever. Now, you say, sir, 1,000 rupees doesn't matter for us. Of course, it doesn't matter for you. It doesn't matter for that business. They are spending 1,000 rupees because they are earning 1 lakh rupees from the customer, and they are spending 1,000 rupees. But this 1,000 rupees, if you multiply by 365, it matters. It matters because if you're offering tea and coffee to most of your customers daily, in daily you say 1,000 rupees you're spending, doesn't matter. But if you multiply 1,000 by 365 for the whole year, it matters. So that's what I'm saying. It is the item having significant effect should be disclosed. Means whatever information which have a significant effect, this tea, coffee you are offering daily to your customers, those customers who are coming to your showroom, you are offering them, you are providing snacks, you are providing tea, coffee, cold drinks. Now, this significant effect should be disclosed. I hope it's clear. Because daily you say some 1,000 rupees doesn't matter for us, but if you multiply by 365, you are spending about 3,65,000 rupees. It matters. So this item should be disclosed. So I'll give you an example. I'll give you a listen, and tea or coffee you are offering to your customers. It should be recorded because you are spending money in this. You are spending money in cold drink. You are spending money in snacks. So this principle is called principle of materiality. items having significant effect should be disclosed. Is it clear? It may happen that one fact is it may happen that one fact is material for someone, okay, does not impact for others. Okay, is it clear now? Principle of materiality. Now we move forward to next one. Okay, the next principle here is, they say that principle of prudence or principle of conservatism. This is an important one, and it's a very technical one also, because you understand it plays a very important part. Now it's based on the policy of playing safe. Now how? I will give you example. For understand term, what is principle of prudence or conservatism? I told you it's based on the policy of playing safe. Now what is this? It says that according to this principle, all anticipated profits should be ignored. Bhul jao. But all anticipated losses should be accounted for. You understand them? All anticipated, this principle based on policy of playing safe, they say according to this principle, all anticipated losses should be accounted for. All the accounted for. All the losses should be accounted for. But main thing is all anticipated profit should be ignored. Okay, now this conventions requires that profit in anticipation should not be recorded, but losses in anticipation should immediately be recorded, even if there is a remote possibility of occurrence of such losses. I hope here, note down the same. Should be accounted for, okay, and all anticipated profit should be ignored. I write here, all anticipated profits, all anticipated profits should be ignored. Should be ignored. This part is clear? Understand them? Now, they say that you have to record all anticipated losses, but you cannot record all anticipated profit. Now, why I am saying this principle? First note down, then I give you the explanation part of the same. All anticipated profit should be ignored, but all anticipated losses should be accounted for. This convention requires that profit in anticipation should not be recorded, but losses in anticipation should be immediately be recorded, even if there is a remote possibility of occurrence of such losses. Okay, now example. Now how this principle of prudence work? I say is playing safe. Now how playing safe? Now suppose you are doing business, separate business from your father. I just give you an example. So you are doing separate business for your father. So separate business from your father. Or your father says, tell me, bhai, how much profit you going to earn in this year? Suppose you have a chance, you have say, I can earn rupees 5 lakh. You have a full confidence that you can earn 5 lakh. But in order to being safe, कि father क्या बोलेंगे? Say, no father, I can earn round about 4 lakh. I can earn round about 4 lakh. Or suppose you want to, you can earn 10 lakh rupees. You can earn 10 lakh rupees, but you are saying, I can earn round about 8 to 9 lakhs. Means you are playing safe. You are playing. Because you feel that there are some anticipated losses are there which should be occurred, which can decrease your profit. कुछ ऐसे लॉस आ सकते हैं जो आपके लॉस को, जो आपके प्रॉफिट को कम कर दें. तो you are mentally prepare of the same. Means you can earn 10 lakh, but you are saying to your father, I can earn 8 to 9 lakh rupees. Now why you are showing all this thing? Because you are playing safe. Because you know that there are some anticipated profits are there. There are some anticipated losses are there which can occur in coming months. In coming months, then your profit will decrease. Then you are in front of your father. You feel ashamed. You promised me you can earn 10 lakh rupees, but you are earning 8 to 9 lakh rupees only. That's why you are playing safe. You पहले ही आपने कह दिया कि I can earn only 8 to 9 lakh rupees. So this principle is based on the policy of playing safe. I hope it's clear. Understand that? Now one more example I can give you. Now suppose in your class, suppose Rachit is a person. Rachit is a person. He feels that in English, in maths, in BSc, business studies, or even in accountancy, he say in English he can earn 90 marks. In maths he can get 95. In business he's thinking that he can secure 95 again. In accountancy he thinks that he can secure 100 marks. He's feel that. And his father asked that, "Bhai, show me your result." He said, "Father, my result will be declared after 1 month." Or say, "How much you can get? How much you get in English?" So before you are playing safe. कि बाद में शर्मिंदा उठाने पड़े, हो सकता है मैंने कुछ गलत कर दिया हो. He's saying, I can secure 85 in English, right now 90 in maths, 90 in business studies, and about 96, 97 in accountancy. Now he's playing safe. You understand that? It's not an economic event, I know that, but I'm giving an example in your terms. So playing safe means all the anticipated profits should not be shown in the books. Okay, but all the anticipated losses, जहाँ पर loss occur होते हैं, it should be shown in the books. Now, example of anticipated losses. Out this clear? Now, examples of how the anticipated losses can occur. Now, like how the anticipated loss can occur. Creation of provision for doubtful debt. If you create provision for doubtful debt, creation of provision for doubtful debts. Okay, now what is this? Creation of provision for doubtful debt. Now, you sold goods in business. You know that there are a lot many times we check on cash basis or on credit basis. Now, suppose you sold goods to Mahesh, and it means that you have to receive 50,000 rupees. You sold good to Mahesh costing 50,000 rupees. It means that you have to receive 50,000 rupees from Mahesh. आपको कितना receive करना है? 50,000 rupees. Okay. Now, Mahesh भाग गया. He ran away. And there's no idea where Mahesh is. Even 3 months are left. He promised to pay his whatever debt, whatever the amount he has promised us to pay within a month. लेकिन 3 months के बाद भी उसका कोई पता नहीं है. We cannot able to find out where Mahesh is. Now this call means you lose your money. You lose your money. That's why we create provision for doubtful debt. There is some person in a business where we lose money, जिनसे हमें पैसा हो सकता है ना मिले, और या तो ठीक है, we have to take some other measures to recover money from those guys. Now this time called we got creation of provision for doubtful debts. Now what is doubtful debt? Which is not doubtful. From debtors, when we sold goods to other person, the other person is debtor for us because we have to receive money from that person. Now, there in business there are certain person are there which remain doubtful whether they can pay or not. So this term is called provision for doubtful debt. You create a provision for doubtful debt. It can be created from an amount of debtors. Suppose in a year the total money you have to receive from debtors, total money is 1 lakh, and you should think that there's round about 5,000. The 2-3 guys are there, those from whom we have to receive 5,000 rupees. They are still doubtful. So you mentally people in this we create provision कि भाई इतना पैसा नहीं मिलेगा. So mentally people receive, you should receive 95,000. So how much you make? The provision 5,000. Similarly, we also create create provision for discount on debtor. Create provision for discount on debtor. Discount on debtors. Now, create provision for discount on debtors. Now, discount on debtor means suppose Mahesh is a person from whom you have to receive 50,000 rupees. You sold goods to Mahesh, you have to receive 50,000 rupees from Mahesh. Mahesh से कितना पैसा मिलना है? 50,000. But you need money immediately. You say Mahesh, if you pay money within a week, I give you 2,000 rupees discount. It means that how much you are receiving from Mahesh. If Mahesh agrees on that, the Mahesh will pay 40,000. The loss of 2,000 there, but you require money immediately. So you give him a discount. So that discount you also created. It's a loss for you, but you need money immediately. That's why. To me, these are things which you created. Similarly, closing stock is valued at cost or market price, whichever less. Now, on third point is the important one. We create, these are anticipated losses, creation of provision for doubtful debt, creation of provision for discount on debtors. Third important part is, okay, closing stock is valued at cost. Closing stock is valued at cost. closing stock is valued at cost, okay, or market price, whichever is less, or market price whichever is less. Again, now why? What is my closing stock? The stock which left, the stock which left unsold till 31st March. Now this stock can be utilized in 1st April. लेकिन 31st March तक ये स्टॉक नहीं बिका, that's why closing stock. Now the value of closing stock, suppose the value of closing stock as per your book is mentioned 50,000, but due to technical things, again when you open when you take the opening stock on the beginning of next year, the value of this stock is 45,000. To you measure 45,000, not 50,000. Or suppose at a time of, again, what is the closing of this year is the opening of next year. Whatever the closing stock this year is the opening of next year. We already discussed this. The stock part, the inventory part, the stock of different types. So the closing stock value is 50,000. But okay, due to technical things, due to changes in the business, its value increases. Suppose there is shortage here. This value increases. It measures 60,000. But what this principle says that we record whichever is less. The closing stock is valued at cost or market price, whichever is less. That means if the value increases, we note down only the value which is less. I hope it's clear. So these are the part. This principle is called principle of prudence or conservatism, which plays safe. I hope this is clear. That means according to this principle, all anticipated profit should be ignored, and all anticipated losses should be accounted for. The conservatism requires that profits in anticipation should not be recorded. You don't need to record कि कहाँ से immediate profit आ जाए. That should be ignored. But losses in anticipation should immediately be recorded. If there is a remote possibility, even if there is a remote possibility that it can be occurred. Okay, is it clear now? So this principle is called principle of prudence. So we done the 6th principle today. In the next video, we will do the rest 5 others. Okay, so till then, live happily, work hard, and live safely. Take care. Bye.